Hello, friends. Good afternoon. Good Friday to you. We're getting this thing started here. Look, my software is a little laggy, but it says I'm live, so give me something in the chat to let me know if you can hear me. Hey, Gino. Austin. Big Shroom. Hey, everybody. Glad to know it's working. I had a bit of a lag on my software there where the chat wasn't moving at all, but now it's working. Now we can see everybody. Okay, let me tell everyone we're live on Twitter real quick. So, good to see everybody. Good afternoon. Let's do a proper intro, yes? Hello. Welcome, friends, to Alpha Beta Soup Live. I'm TXMC. It's Friday, September 22nd, 2023. Hope you're all having a great day. We're not going to waste any time. We're just going to get right into it here. Got a few things to talk about. It's FOMC week. We've had prices moving around. So there's actually a couple things to talk about, you know? And so that's what we're going to get into. If anyone's having any problem, looks like everyone's hearing me just fine, so I think the software is working great. Smash that like button for me if you can. And if you haven't subscribed to my channel, please do that. Those are the best ways for you to support my content, is to be a participant on my channel. So I thank you for that. Oh, so where should we start? You know, I think rather than starting on the Bitcoin price chart, I think it makes more sense first. Let's talk about FOMC, and then we'll jump over here to BTC. We'll look at SPX. We'll talk about other equities, and then we'll get into some other charts and things. But what we'll first start with is yesterday's FOMC. This is the summary of economic projections that they put out once a quarter. And it's a signal of what they think is possible to happen if their policies are carried out in full. And it's a survey of all 18 members of the Federal Reserve Board. So it's important, before I mention any of the numbers on here, it's not a forecast. It isn't a forecast for what should happen, but rather it is what is in the heads of the Board of Governors. Individually, they put them all together as a group, and this is kind of what they expect to happen to things like unemployment, inflation, the federal funds rate over the next couple of years. The last one they did was in June, and you can see under each of these rows it says June projection. That's what the values were 3 months ago. And then the top row is the values today. And there's a couple of things that we can really point out here. First couple places we're going to look. We're going to look right here. We're going to look right here. The inflation numbers are not really that notable. They all kind of stayed in a similar bound, and they don't tell a huge story. GDP numbers are still in the same kind of 1.5–2% range they were in, but it's worth noting that next year's GDP, they upgraded it a little bit after having to upgrade this year. They thought we would only have 1% real GDP this year. But there's a couple of things about this that jumped out to me. The first thing that jumped out, so people are asking me to turn up the volume. This is pretty loud here on my mic locally here, so I don't know if I can make it too much louder without degrading the sound quality. So I'll turn it up a teeny bit. Okay, so unemployment they show at 4.1%. The cycle low of unemployment is 3.4%. So they're projecting, and they've come down, right? In June, they thought unemployment next year would be at 4.5. Well, they've come down to 4.1, but that is still problematic. And for any of you who saw my visit yesterday to Trader Exo's stream, I talked about some of these points. So some of you who watched that may hear similar points today, but this is my stream, and this is where we're going to go over these things. So they show unemployment. They've reduced their expectations of unemployment for the better, but they still show it rising another 0.3, 0.4% from where it is now, and what it would be a total of 0.7% off the cycle low. And there's a reason why that's a problem. And that problem is, where is my unemployment changes chart? I always have trouble finding it on this big screen. Here it is. So some of you have seen this chart before. This shows the unemployment rate back since the series began in the late 40s. And there's a couple of things about this we have to talk about. So we mentioned over here, they're talking about unemployment jumping to 4.1%. And we said the cycle low was 3.4%. So that difference is 0.7, right? That's the delta. Well, if we look back in the past at every time that unemployment has risen 0.5%, which is less than what they are showing on a 6-month or 12-month basis in red or blue, that's these lines down here. That's when these little crayon-looking lines appear at the bottom of my chart. That's when unemployment rises that much in a given time frame. You'll notice those red and blue lines only exist next to these vertical gray bars. And these vertical bars are recessions. Many of you already know that from seeing my charts for a long time now. These vertical gray bars are recessions. And the only time we ever have unemployment move at least 0.5 percentage point or more in a year, it's during a recession. So we've got the Fed over here projecting an unemployment rate move that fits only with recessionary periods from the past, even though they have upgraded their expectations for unemployment. They've shown it getting better than what they thought. It's still within a recessionary window based on the behavior of unemployment. And that's because the unemployment rate is a slippery slope upwards. Some of you have heard me characterize it that way before. This is unemployment at the top. This is what we're measuring in these little colored lines down here. And you'll notice every time we have these red and blue lines showing that it's moving quickly, it's when the black line is shooting higher, right? You see that pretty much every time. And it doesn't do that outside of recessions. Because outside of recessions, we typically have decent job growth. We have relative full employment. And over long periods of time, unemployment tends to drift downwards. You see how it did here through most of the 60s, how it did here through the middle 80s. It has moments, events that cause it to spike. And then once we come out of the recovery and we start building back into an expansive phase, unemployment falls, right? That's the dynamic. But when it turns and it goes higher, it does so very quickly, and it does so in an uncontrollable manner. So I think that it's important to identify what I will call hubris on the part of the Federal Reserve, that they would linearly project unemployment to simply, coast its way up to 4.1% from its current, I think 3.8 is where it is now. Yeah, 3.8%. That it's just going to coast a little bit higher and then stay there. That it's going to go up like this and then just go sideways, right? Do you have any instances on the chart for unemployment really where it just does this for like 3 years, which is kind of what they're showing? No. Like we've had a couple of instances, maybe that you could say maybe that happened in the late 60s right here. That's like the only time that's ever happened. So their projections for the movement of unemployment have me a little concerned. It's not the be all end all. It doesn't guarantee that we have a recession, but I think what it means is that if we get to the period of this cycle where the Fed is pressured to ease, where they see labor softening and they see unemployment rising, then based on what they're showing over here, it's possible that in their mind's eye, they won't immediately see a reason to act, right? Because they've already suggested that they're comfortable seeing unemployment rising above 4%. And what I'm suggesting to you is that if it rises above 4%, there's a high probability that it rises much faster than that, and it goes far beyond where they think it will go, and that it could go up to 5% or 6% or higher, because that's what it usually does, right? On average, it moves about 3%. Historically, that's typically the range. It's about 2.8, 3% or more from its baseline to its cycle highs. So that was my main takeaway from the unemployment piece on the Fed's projections yesterday. Now, the other thing I want to talk about is right here. It's their projections for the federal funds rate. And this is what I believe has contributed to the movement that we've seen in risk assets the last 2 days. They've been selling off, mostly equities. Bitcoin did a little bit, but mostly equities. And that's because these projections right here are higher for longer. That's what this is showing you. So the federal funds rate as of June, okay, so right now it's 5.5%, right? It's about 5.5%. And what the Fed said in June was that next year, 2024, they thought federal funds would be 4.6. So that's 100 basis points of cuts that they had built into their mind about what they thought would happen next year. And then 2025, it went down to 3.4. So another 100 basis points, 125 basis points or so of cuts on average in 2025. Well, what do you notice? The new projections are higher both for next year and 2025. The expectations for the federal funds rate are higher, and in both instances, it's by 50 basis points. So what that means is that in this window of time, 2024 and 2025, the Fed has essentially negated or removed 100 basis points of theoretical cuts. They are showing that they anticipate fewer interruptions to higher for longer over the next couple of years. They thought 3 months ago that they would have to cut 100 basis points next year. Now they think it's only 50. They thought they were going to have to cut another 100 basis points in 2025. Now they think maybe it's only 100 in total from that. So I think that they're showing right here, rates need to stay higher. They need to stay that way for longer. That's what they've been saying since early last year. However, the market has not believed them. And now that they've gotten close to what is likely the terminal rate, it's probably close to where we are now, somewhere in the 5s, maybe 6% is the terminal rate. Now that we're near there, the real debate for the market is, okay, how long can we stay here? How long can we theoretically operate with $33 trillion in national debt, with interest rates at 5% or higher? We've got home unaffordability at record levels. The entire credit edifice has completely ground to a halt, and I will show you guys that chart here in just a little bit. And what's really upholding the market so far, the economy, I should say, what's helping to drive the economy is incomes. That's the primary leg of the stool that remains. And so we have to wonder if they are showing weakness in unemployment to a level that is recessionary by nature, and they are also suggesting higher interest rates for a longer period of time than the market anticipates. I think there will be frictions to them interrupting economic softness. Like if we start to appear like we're going into the recession, they may hold off. They may not be immediately moved to act because of the nature of their projections and what they think the economy actually needs. So that's why I think equities sold off so much over the last 2 years, is they saw this red box. They saw 100 basis points of theoretical cuts removed from the next 2 years of Fed policy. And that's led to a sell-off, right? I said I'd start with Bitcoin, but let's just look at the S&P. You can see what it did, right? It sold off and it set a lower low in a local sense. It broke below the low from mid-August. And it's in an interesting spot because from a support perspective, that is the top of this consolidation range that we've been in, that we were in, most of last summer into this summer, right? Until we broke above it. We were in this range right here. Now we're on top of it and we're looking for it for support. I talked about this a little bit with XO yesterday, and what he said to me was, well, if we start forming one of these, if we sweep this, which we did, we have broken below this, we've swept this. If we climb up to here and then we break down and we don't look like we're going to continue higher and make new highs, if we actually form a lower high after forming a lower low, Well, brother, that is a warning sign. That's a warning sign for equities. It's a pretty juicy short setup right there, maybe with an invalidation here, or maybe if you're more aggressive, maybe it's here. And then what you would expect, assets would go down there. If that's what we get. If we crawl up and we cannot surmount these levels here, this kind of consolidation right there, if we can't get above that, that's a big red flag. And I would expect that we would see lower risk asset prices. And if we got below that level, then where's the next support? I mean, you could say that maybe there's a level here. Maybe there's one above that. Maybe it's right here. 4,200 maybe on the S&P if we get below this level. How much of a drop is that? 3%. No one would really like to see that. It's not my forecast, but if we're going to watch price action here over the next few days going into next week, I think that's what we need to watch for. We need to see if we're getting strength and if we break above this descending trend line that we've started to form here. But what I've kept in the back of my mind about equities is that they have the potential to rally when the market sniffs the end of Fed tightening. That's happened before. We have a precedent for those things. I can show you that right here. So look up here in this box. We've got market eras, right? And we have percent change in the fourth column since the tightening ended, since the last rate hike. And you can see we've got 4 examples in the past of getting strong rallies to the upside after the last Fed hike. The one in 1929 doesn't really count because no one knew that it was the last hike. They were just tightening to try to slow speculative credit growth. So we're going to leave that one out. But in the modern era, 1990, the Great Financial Crisis, and COVID, when we had the last Federal Reserve hike, the market ripped about 20-30%. So I've kept in the back of my mind that our market today could do that, and it would make sense considering how resilient it has been this year in the face of a lot of bad news, right? Particularly this part of the market right here. This part of the market was pretty strong. And there were a lot of people thinking right here when we had the banking crisis that we had no business going higher. We just climbed a wall of worry all the way up to 4,500 on the S&P. But we have the potential to rally higher if the market sniffs the end of tightening. But there's a caveat there that if we go look at the other times that it happened, right, these other 3 instances of massive rallies, which I see a lot of bulls point to, hey, look, the market pumps when tightening is over with. Yes. However, how much time did it get to do that? Well, that's this column right here. This is the number of months from the last hike to the top of the market in that cycle. And all 3 of those eras got more than a year to pump. From the last time the Fed hiked till the market actually reached its pico top and rolled over, they had over a year for that to happen. Does anyone think that we have that scenario available to us today? Let's say the Federal Reserve hikes in November, and that's the last one. Does anyone believe that we have 15 months of runway in front of us from that point for the market to rally before we were actually to see a recession? I don't think so. We are very deep into the process. We're in like the 5th or 6th inning of this process. So there's almost no way in my mind that we have the same setup. We may have a similar one. We may have a smaller degree of a rally. We may not get one at all. But if we're going to try to compare eras, and I see this comparison made a lot, it is important to point out that when we had these big rallies, we had a lot of time for it to happen in. And I think that that's just something that we may not be setting up for here. I don't think that we have 12 to 18 months ahead of us of runway to allow this kind of a move to play out. It could play out in a shorter window of time. It could also not happen at all. But that's the criteria. That's what happened in the prior eras. They had 15, 16 months and they ripped 20, 30%, and that was the top. So I've kept that in my mind with equities. However, if this starts to break down and we start, printing candles down in here, I don't really know how likely that is. I think maybe we're in store for something different. Unsure exactly what, but something different. It's not in my nature to try to predict where the price is going. There are people out there who they love to use all their little TA wizardry and try to project a price way out into the future for where the S&P is going to go, where Bitcoin's going to go, etc. I'm not trying to do that. I'm just trying to think through scenarios, trying to figure out, okay, what criteria led those markets to be able to do what they did? And can I find any similarities today? That's kind of how I think about it. That's what we're looking at on the S&P. We're in a really tricky spot. We have to hold this level here for any real optimism, and then we have to break above this high right there. If we can't get above this high after this bounce next week or the week after, that's a major red flag. If we start bowing over, if we maintain that descending trend line, that's a short op right there, and I would target probably here, and then maybe here, and then we'll see what happens. So let's look at BTC. I see you guys running in the chat. I'm keeping my eye on you, but I got to get through all my thoughts so I don't leave anything out. I will jump into the chat here in just a little bit. Make sure you smash the like button. We got 200 people watching. We don't have that many likes. We have about half that many likes. So that means a bunch of you guys are watching me put in some serious work here and you haven't hit the like button for me. So please do that. Please subscribe if you haven't already. Those are the best ways to support me. Okay, so let's look at Bitcoin. This is a daily chart. Not a lot has changed on BTC, but we can still go through the motions here and assess where we are in the cycle. This is our line of truth. This is the one we have used in all the prior live streams. It's the Luna Wick, right? You guys are familiar with this by now. Those of you who are regulars on here, you've seen this a million times now. It's the Luna Wick. It's been the pivot, right? It broke above it. It was support. It was support. So what we're looking at now is, okay, we set a higher low. We got over here. We had this really ugly action. The last time you and I spoke, the last time we had a live stream, it was in this area right here. So we hadn't gotten this move, but we have now. And I got pretty bullish right there. I went long right here. I'm still holding that long. I've taken a little bit of profit, but I'm still holding that long. And the reason for that was that we set a higher low. Oops. That we set a higher low. And I have identified this big yellow line right here as my line of truth. And if we broke below it and held it as support, which it looks like we did at least momentarily, then I was going to get bullish. But, you know, to couch that a little bit, we have come up and we've started to curl here at this kind of key level. We've curled here. And because of the nature of this super clean breakthrough, there's a high likelihood that we need to come back down and test it again. Now, I'm not saying that has to happen, but that's just kind of the nature of price, right? If you give it a range to work in, it's going to work from one side of the range to the other. And if it's going to break out of that range, in a lot of cases, it needs to cross the river and get some juice and shoot back the other way. So if we're sitting in a range here, sorry, I'm kind of jumbling with my tools. If we just kind of consider this, this is not perfect, right? I'm just kind of drawing a box around where price has been recently. I think it makes a lot of sense that we would come back down a little lower, and then we would test this area to go higher again. Maybe we don't break below that low, but maybe we break below the yellow line as we've done a few times here to find it as support. That's possible, right? I'm not going to get too dialed in on where price needs to go because I think it's hard to read this market right now. These aren't conditions that are really favorable for taking a lot of trades. I mean, look at this. There's no volatility here. Like, look at this price action. This is absolutely hideous. It was really nice to see this volatile move. And like I said, I did go long. I'm long from about 25.1, so way down here, which is an aggressive entry, more aggressive than I would have normally taken. But it's because I saw where the actual low was, and I had a really tight stop. Right? If it goes below 24.7, I'm out. Period. I'm out. And it's so close. I mean, I got in right here, right? It was too juicy to pass up. So I got long there. I would ideally like to hold it up into this level and, you know, maybe up into these levels, but I won't if it doesn't give me that. And if we come all the way back down here for the back test, I'll just get out because I can always get back in, right? If I'm wrong, we'll see how it goes. But, the thing for Bitcoin is that it's kind of along for the ride with what's going on with broad risk assets. Bitcoiners don't like to hear that, but it's true. It's always been true. It's never been the case that Bitcoin lived in its own little bubble. It's always been the case that it has been sympathetic to other assets, to other markets. And the fact that it is a traded asset makes sense that it should be sensitive to macroeconomic factors. It should not live in its own bubble. So right now we're a little beholden to the macro picture. And it's just really hard to get a read on BTC. You know, it's just been a really tough market to read. And I think we're in a kind of spot where it is waiting also for clarity from macro. And you can see that because it's kind of trapped in between some really high time frame ranges. One of those is like if we look at the last couple of years, this is a 12-month chart. And what I like to do, you guys have heard me say, I like to look at high time frame ranges, particularly ones that broke market structure, and find where price is still respecting that range. And you can see that in a couple of places here. So if we put this 2020 range on, the market is 2020. Put this 2020 range on, you can see that the open of this year was right at the midpoint of the 2020 candle. And the 2020 candle was the one that broke market structure to the upside, right? It broke above the prior bull market. So we came up in the bull and then we broke back down inside of this range. We're still dancing in it. And like I said, the open of this year was perfectly at the midpoint. So that's one range. But we also have another range, and that is last year, right? Let's mark this one a different color so it stands out a little differently. We'll color this one red. Put 2022 on here. And what do you see about this? The high of this year, so far, the Pico high was the absolute perfect midpoint of last year's range. So we're kind of trapped in two different areas. The market's trying to figure out, okay, are we ready to accept 30K as our new floor? Well, clearly not yet. Are we ready to accept the midpoint of last year as a new price range? Well, clearly not yet. And so I think that it's going to take something. There's going to either the passage of time or perhaps some developments in the news cycle or in the macro data that allows us to really get out of these ranges, because this has been a major bugaboo. I mean, how long have we been here? This has been 500 something days that we've been in this little box here in between the midpoint ranges of last year and 2020. And what else was I going to talk about with equities? Oh yeah, breadth. That's what we were going to talk about. I wanted to talk about the dispersion in the market. So we had this big sell-off. We had this sell-off this week because of everything I said was going on with the Fed and the higher for longer. And if we're thinking, okay, maybe we're at a place on the S&P, maybe we're at a place where it tries to find some support. We had an ugly week, but it is holding this level. So where could we see signs of capitulation? Can we identify any areas of capitulation? So what we're looking at on the chart here, this is breadth of the S&P. This is the S&P 500. We've got it shown in a couple of different ways. So up at the top, there are 3 moving averages. Let me put the labels on so you can see them. The 200-day in red, the 50-day in yellow, and the 20-day in blue. Down here at the bottom, the same colors is the percentage of stocks in the S&P 500 that are above those moving averages. Excuse me, I've got some hiccups and they're coming up right as I'm talking. So this is a way of showing breadth. It's a way of showing strength in the market. How many stocks are above their 200-day moving average? How many stocks are above their 50-day moving average? Let's take off the 20 because the 20 is just a little too short term. What do you notice here on this yellow line? This yellow line represents the 50-day moving average. There are 18% of the stocks in the S&P that are above their 50-day moving average. And that value is the lowest value since the banking crisis in March. So we've seen a swift washout in breadth in the S&P on this move this week that just barely set a new low and so far has maintained some higher time frame support. So we saw a washout in breadth on the 50-day moving average for the S&P. And then also, if we look lower here, This is an oscillator that shows the number of stocks that are advancing versus the number of stocks that are declining. And it's shown the same way that a MACD is, the moving average convergence divergence tool that a lot of people use for trading. And so we've got a short moving average and a long moving average of the amount of stocks going up and down in the market. And so when you see this rising and lifting, what it's showing you is that more and more stocks within the index are going higher. When this number is falling, then we have fewer and fewer stocks rising. And then when it gets down to the negative, we have a majority that are declining. Well, what you can see on the fast moving average, which is the blue line here, I'll even turn off the other one just so it's not as confusing. I'll turn off all this stuff. This is the advanced decline moving average, the quicker moving average for the S&P. And what do you see? Just like up here, we saw a washout in breadth of stocks below their 50-day moving average all the way back to March, a nice washout of the move higher from the summer. We also see the same thing on the advanced decline line. You see, it's now below this value. It's touching the bank crisis area from March when we had a lot of stocks declining altogether. And this is happening as we've now identified a couple of times, reached an area of support, potential support that could hold here on the S&P. So I think that's positive. I think it's good. This is similar to like a capitulation wick in an uptrend on Bitcoin, when you see those late longs liquidated and then we're actually able to move higher and it creates some of that FOMO that pushes the price afterwards. We see the setup for that possibly happening here in the S&P. If we go over and we look at the NASDAQ, exactly the same kind of thing, same setup. We see an even bigger washout, right? Now, we didn't do TA on the NASDAQ. The NASDAQ is actually, if I show you real quick, the NASDAQ actually held up better than the S&P. It did not set a local low. However, it had an even bigger washout in breadth. Relative to the 50-day moving average, it is now at 2022 levels. Remember I said the S&P, it broke down right here to the banking crisis area of breadth. The NASDAQ, in terms of the 50-day moving average, which is kind of a medium-term moving average, the number of stocks above that level is only 19%. That's the lowest value since October of last year. This is right around the time that the yield curve inverted back here. So I think this is actually a positive, that we have seen the NASDAQ finally showing a little bit of a crack. And perhaps, if we can hold these areas, this can add fuel for us to move higher. And, similarly, down here, we see the same thing with the breadth, with the advanced decline line. Just like we looked at on the S&P. What do you see? It is broken down below the March lows. It's now back here in October, just like this 50-day moving average breadth indicator up here. So we see a pretty clean washout in equities. But on the NASDAQ and on the S&P 500, we identified that the S&P was sitting on top of key support. Bitcoin, likewise, is sitting on top of a key pivot. And so I think this is a really interesting place. And hopefully next week we can see some positive price action. Hopefully we can start building back up and getting up near these highs over the next few days and actually get above them. That would be wonderful. I'd love to see that. That's what I wanted to talk about with breadth on here. I don't look at these charts all that often, but it is important to look at them sometimes. And when I noticed this kind of a breakdown in breadth kind of across the board, at a key level for price, then that could be that could mean that the move is done, but we'll have to see. So continuing with the theme of market dispersion, there are some dynamics today in the stock market that suggest that we still have trouble ahead of us, that we are not in an early bull phase. And now some of you listening to me may be like, well, TX, we know that, dude. You have been bearish. You've been talking about a recession. So we're not surprised to hear you say that. But there are still a lot of people that are pointing at the percent gain this year of the S&P, of the NASDAQ. It had one of its strongest years ever. And they're saying, hey, we're in a recovery. We are going higher. AI is here. Productivity boosts are just over the horizon. But if we look at the S&P and then we look at other members of the stock market that tend to move with the broader index when we have recoveries, they're not showing the same kind of optimism. So if you go back in time, if you go back to like the late 80s and you look all the way forward, every time there's a bear market, the Russell bottoms at the same time as the S&P, and they both move higher together. The Russell 2000 is smaller cap equities, 2,000 smallest stocks in the stock market. Those two tend to bottom together. Same thing for micro caps, which is currently represented by this yellow line here. This is a micro cap index. But what we've seen this year is the S&P pulling higher, but all of these other measures of breadth within the market, the equal weighted S&P, so not weighted by market cap, the Russell 2000, which I said were the small cap equities, the micro caps, the tiniest companies in the stock market, and then credit markers. These are ETFs that represent corporate credit, both high yield and investment grade. All of these things are significantly lower than where the S&P 500 is, than where the NASDAQ is. Why is that? Well, it's because, friends, this year's move higher in equities has been a very exclusive dinner party that not many were invited to. It began led by what's called the Magnificent Seven, which is like, Amazon, Apple, Microsoft, Tesla, NVIDIA, the biggest companies. But it has since broadened out a bit. We've got a few other names in the mix that have seen upside. Some of the financial sector has started to recover because they're not having to pass on a lot of that pain thanks to the Fed and what they did in March. But if we're in an uptrend, if we're in a new bull phase, as many people, as the optimists would like to believe, then these other indications of the market, these other measures of the market, they need to be up here with the S&P. They need to have bottomed. But that's not really what we're seeing. If we look, let me close off some of these because I know it's a really busy chart. I mean, if we just look at the Russell, look where the Russell is. It's still in a range. It's been in a range all year long compared to what the S&P has done. Right? The S&P is above its August high. It just bounced off of it. It's what we just spent the last 30 minutes talking about. But the Russell is not participating in this rally. Now, people like to point out to me, well, the Russell has a lot of bank stocks in it. Yes, it does, but it's not only bank stocks. There's 2,000 tickers inside the Russell. It does have a lot of smaller banks. There's also a lot of smaller tech companies. There's biotechs in there. There's a mix. It's a broad mix. And the Russell has been range bound. The Russell hasn't gone anywhere. This is very atypical if we have established the low of the bear market. If it was indeed last year, as many people believe, if this was the bottom of the stock market, then why is the Russell range bound in that same place while the S&P went higher, while the NASDAQ went higher? Why is that the case? And I would suggest to you that it's because we are not through the woods yet, that there is still more to come, and we haven't seen the last shoe drop. I don't know what that shoe is, what it looks like, or what it does. But if I'm just looking at historical tendencies, all of these measures of credit, of micro caps, of the Russell, of the equal weighted index, they all move together off the lows. And they haven't done that this time. So that raises a red flag for me. And then I thought, okay, let's look at the correlation then. Maybe it's not just a matter of it needs to go up to the highs, but we do know that they have a relationship that, let me get rid of some of these others. What we know is that the equal weighted index and the Russell 2000, they have a high correlation to the S&P 500 most of the time. Well, what have we seen recently? We have seen a complete breakdown in that correlation. So these are two lines representing rolling 12-month correlations between the S&P 500 and the two stocks I was just talking about, the equal weighted S&P, which is called RSP, and the Russell 2000, which are the 2,000 smallest stocks in the market. And you can see the correlation usually stays high. A high value here means that this ticker is moving in pretty close sympathy with the S&P on a daily basis, on a rolling 12-month basis, I think I should say. When this line breaks down, that means the correlation is breaking down. That means that they are no longer moving together, right? They are moving separately through idiosyncratic means. If you look up here at the top, this is the one I want to focus on, the black line. We'll focus on this one first. This is the S&P correlated to the RSP, which is all of the same stocks given equal weighting. And that correlation is completely broken down. It's broken down below the lows from COVID. It's broken down below the lows from the great financial crisis. And this is the exclusive dinner party that I was talking to you guys about. This is what it means. That the market cap leadership in the stock market, the biggest names, are living in a different universe from the rest of the market. The Russell 2000's correlation has also broken down. It hasn't broken down below 2022. It hasn't broken down below this part of 2015, but it is breaking down in dramatic fashion. It's below where it was in the great financial crisis. So if we have the Russell and we have the equal index and their correlations are not matching the S&P, that is a major red flag. There is no other way to characterize it. It's a major red flag. It shows you that leadership is, like I said, on a completely different planet from the bottom, call it 90% of the market, 85, 90% of the market. And that is concerning. And there's just not much more to say about it than that. I think that seeing this line, I'll just take the Russell one off just to make a clear chart. That is dramatic. That is alarming. It jumped off the page at me. And I think that this tells a major part of the story of what we've experienced this year. And when you look at it, the breakdown really began at the beginning of this year, right? December 2022, January 23. That's when it started. March, right here. That's when we had the banking problems. So it's worth acknowledging small regional banks, which are smaller cap companies, have been struggling. That is contributing. But for it to have broken down this much is really alarming. Okay. So that's the overview for the market. We will touch, we'll touch on recession stuff a little bit. What did I want to touch on with you guys? Oh yeah. So we've seen a little bit of a bounce. That's where we are with equities. All right. And I think most of you know that I have a bias towards us most likely experiencing a recession in this cycle. I think that we're getting really close to it. I think sometime in the next 6 to 8 months, it will become obvious to us, most likely. And that's my general bias. I'm not married to that outcome. I am open to the possibility of a soft landing. We do still have an example of that. You guys have heard me say a lot about that. But what we've seen in the last couple of months is a small acceleration in some of the cyclical parts of the economy and the income parts of the economy. Now that inflation has come down, real incomes have gotten a slight boost. We've also seen a bit of a pickup in industrial production and real retail sales off of their lows. So what has that done? Well, that has created where on these black lines, which is today's era, the cyclicals and the income parts have seen a boost to their growth rates above this gray line, which represents all the prior recessions. So for a long time, for the last, year or so, 9, 12 months, the current era, represented by these black lines, has been in large part below the average trend of growth of these various pieces of the economy: credit, cyclicals, income, and labor. We've been trailing below those growth rates for most of this saga. You can see credit is still way below that. I'll talk about that in just a second. But the cyclical pieces, the parts that lead us into the recession, they've picked up a little bit. Their rates of change have picked up a little bit in the last couple of prints. Now, it's too early to know if this is a sign of the soft landing. It's way too early to know. We probably need 2 to 4 more data prints to really get an idea. Excuse me, I've got the hiccups again. But we did see a pickup in these areas here, and this has got a little bit more optimism for the soft landing camp. However, we can see that the labor portion over here, this fourth column, is still below the average trend of growth, and it's kind of just following it pretty closely. So it's too early to tell if we're going to have the soft landing or not. But what I come back to when I think about this framework, when I think about, okay, What's the likelihood that we just dig our way out of everything we've been through the last 12, 18 months? We've had manufacturing and retail sales get utterly decimated. The whole productive side of the economy has just been decimated. And so what's really holding it up? Well, usually it's people spending money, right? What are the two ways they access money? They either access credit or they get it through their incomes. Well, that's these two boxes right here. We can see one of those boxes is not going to be a source of strength for us, and that's the credit growth. Credit growth in our current era has been completely suffocated. We've gone from double-digit credit growth on an annualized basis down to almost zero. Almost zero. It probably will go below that value here pretty soon. And what you can see is the average rate of growth of credit leading into recessions after yield curve inverts is considerably higher than where we are today. This has happened as a result of Fed policy. So credit growth, which was quite large last year, has slowed down dramatically this year. And it's almost non-existent, particularly for businesses. There's still a little bit of credit growth happening for consumers. But it's safe to assume that this will not be a source of prolonged economic strength while we're going through this era, because this is exactly what the Fed wanted, and this is what usually happens when they tighten. It chokes off credit creation. But the problem is, I articulated this yesterday on Trader XO's channel. The problem with credit growth being choked off is that there is a lot of insulation from interest rates in the US economy right now. If you think about corporates and households and what they went through as a result of COVID, right? In 2020 and 2021, we had record home refinancing. We had millions of Americans locking in sub 3% mortgage rates for 15 to 30 years. The Fed could raise rates to 100%. They could 1,000%, and it wouldn't matter to those people. They will not be forced out of their homes for another decade or more because of fixed rate mortgages. If you think about the corporate sector, they did something similar. In COVID in 2020 and 2021, a lot of companies issued debt and they termed it way out in the future, out into 2024, 2025, 2027, out through the rest of the decade. So the corporate sector and the household sector, on average, the homeowners, now I know it's not everybody, but the broadest group of homeowners, of households, they are relatively insensitive to interest rates. They don't really care that much. I'm one of those people. My home was refinanced in 2021. The Fed could raise to literally any interest rate on planet Earth, and it won't affect my home ownership in any way. I'm not leaving. I may be trapped in my home, but I'm not leaving. Now, that's a big problem for people trying to buy a new home, for people trying to create a family, for young people who just got together and they're trying to go through that process of household formation. This is really tough for them. But for the majority of people who already have a home, they're not really being affected in the same way. And so if credit growth is being choked off, then that means it's incomes. That's what's left. That is what's left to help provide juice and fuel for GDP, because we're in an economy, the US economy is one that is 2/3 people spending money. If you look at GDP, all the things that contribute to GDP, 68% of it is PCE, which is personal consumption. It's you and me buying stuff, paying for our homes, going to the grocery store, going to the movies, going out to eat, taking vacations, putting our kids through college, whatever the thing we're spending money on. That is 68% of our economy. And so if credit gets choked off, what's left to power that is people's incomes, thus the labor market. Because people's incomes is them having a job, right? So these two become intrinsically linked. We know that wage growth has been strong during this era. We also know that there's a lot of unions moving around to get even bigger raises for their people. The United Auto Workers are currently striking. The UPS drivers got $160,000 a year. There's been some other strikes that have been whispered or that are starting to form. And that will help to power wage growth while the economy is still moving. However, that puts all of the pressure on the jobs market. All of it. The entire fortitude of the economy now rests on incomes and labor. And that is where it gets kind of dicey. So let me find my job growth chart. Sorry if I'm jumping around. I have so many different dashboards, I lose track of where my things are. Okay. So I said that pressure is now on the jobs market, correct? So let's look at the jobs market and let's look at it objectively. So this is job growth in the post-GFC pre-COVID era. From 2011 to 2019, this was the average rate of growth of non-farm payrolls. See? 6-month annualized basis. That's how I look at all of my growth rates. 6-month annualized. And this rate of growth right here was 1.7%. That was the average rate of growth for almost 10 years, from the Great Financial Crisis to COVID. 9 years, call it. And where are we now? We've come back down and we're squarely in the middle of that box. All of this labor strength has been eroded. It is tapered down, and now we are back in the mean. We have reverted fully to the mean on job growth. So the question now becomes, friends, does this line keep doing this? Or does it just go sideways? It could. We could do this. It's not likely, but we could do that. I don't know why I say it's not likely. It's just lines don't tend to go sideways for long periods of time. But the real question is job growth going to stay elevated? Is it going to stay positive? Or are we going to continue to drift lower and lower and follow what has been the pre-recessionary path of job growth, which you are seeing on your screen here? This is the normal rate of job growth. This black line is where we are today. This gray line is all prior recessions. Since the yield curve inverted, you see that number here on the 1. This is the first month of yield curve inversion. And we're 11 months into our own, right? I showed a little data before that as well. But the rate of growth of jobs is following the recessionary path. It's drifting lower. You see that? And so if we go back and we're looking at it over on this other sheet over, sorry guys. Yeah, if we're looking at it over here and we see this trend is drifting lower, then, we have to hope that this stops and finds a floor and begins to grow at a relatively steady pace so that other things like credit growth like income growth can remain positive and help to power the economy. So I know that's a lot. That's a huge data dump of information. The main points here, if we're going to sum up the last hour of my ranting, the main points here are Bitcoin and equities are sitting at key pivot levels. We have seen an interesting, I'll put it as interesting, washout in breadth within the market, in stocks selling off over the last couple of days on the S&P and the NASDAQ, which set new yearly lows, new local lows on breadth in those two indexes, while they sit atop key support levels. That happened as a result of the Fed and their own projections here showing a higher for longer dynamic on interest rates over the next 2 years. That pushed long end yields higher. The 10-year and the 30-year broke out. That move forced equities lower. That's how we got the washout that we were talking about in breadth, seen over here that we discussed with my charts of the 50-day moving average and the advanced decline lines. And where we are on the economic growth trajectory, the credit market has been completely choked off. Growth is completely fallen off a cliff. It's the worst credit growth in any prior pre-recessionary window ever, period. It's not an exaggeration. If I go look over here, sorry, if I go look, where's my, here we are, sorry guys. If we go look at loans, business loans, today, compared to all prior recessions, it is the worst that it's ever been. And in fact, it's the only era where just 7 months, 8 months, 9 months into the yield curve being inverted, business loan growth was already negative. None of the other eras did that for over a year after the yield curve being inverted. So the credit edifice has been suffocated with a rapid pace. It's completely choked off. And that leaves a lot of pressure on labor and incomes to sustain the economy. And as we've identified, that growth rate of labor has now returned to the place that it was at before COVID, and it's been falling pretty fast. So what we need to hope for is that that pace of fall has been expired and that it will maintain a steady rate of growth, that we will not see negative job growth. Because if we do, because the Fed has already said that they expect to see some labor softening and that they expect to have rates higher for longer, they may not swing into act quickly enough, and the situation could get out of hand really fast. Because, why? Because unemployment rises quickly. And if they're thinking it's just going to dribble up just a little bit and hang out at 4% and not go anywhere, that defies historical trends for this metric. And it puts me on alert. So that's kind of a summary of where we are right now. I know that's a huge amount of information, and I recommend you guys watching it back, and feel free to reach out to me. My DMs are open on Twitter if you have any questions, or leave them in the comments of the video here, and I'll try to get back to you. If you have questions about things I've said that maybe don't make sense to you, that don't line up. When I sit down here to do these streams with you guys, I don't have like a monologue written out. Right, I have a sticky note with like 6 or 7 points on it, and I try to get through all of them. And along that way, it brings up other ideas. I think of other things I wanted to mention, and then before you know it, it's been an hour, and I've been talking nonstop, just barraging you guys with information. I understand that can probably be a little overwhelming for y'all, but I sometimes don't think about it because I look at this data all the time. Right, I've become prolific with it, and so these things just all sit in my head all the time, and maybe I don't convey them in the clearest way. So if you have any questions, feel free to reach out. So I'm gonna pause here. I'm gonna take a sip of water, and then I'm gonna look at the chat, and I'm gonna see what I've missed here for the last hour. We've got 200 viewers. We've got 200 likes. That's amazing. Thank you, guys. Big Shroom with the super chat. I asked about bank deposits last stream, and it might help explain why credit growth is the worst ever. Yeah, we could look at bank deposits, man. Let's pull that up. Let's go look at deposits. We're going to pull it up on the screen like here. Deposits. Deposits, all commercial banks, monthly. 10 years. Yeah. See, bank deposits are something that tends to grow over time, right? It's just kind of perpetually always growing at higher and lower rates of change, but kind of always growing. And if you look at it on a year-over-year basis, well, where is it now? I mean, it's been absolutely abysmal. These are banks losing deposits. Yeah, that could be playing a role in why credit growth is the worst. But I honestly think it's because they're tightening their lending standards. If you look at the survey of the senior loan officer survey, and you look at banks that are tightening their lending standards, the banks are the ones doing it, right? They're making it harder and harder to access credit. And that is something that typically happens in a tightening cycle. The only difference is that we have banks tightening their lending standards up to extremes while the Fed is still in its tightening cycle, when normally this thing happens after they're done tightening. I'll show you real quick. Federal funds rate. Or funds effective rate. There we go. We put this on a different chart, different axis. Okay. And then we'll zoom in here. Now, the red line is the federal funds rate. The blue line is banks making it harder for you to access credit if you are a business. When the blue line goes higher, it means that it's getting harder to get a loan for your business. They're tightening their standards. More banks are tightening their standards. So what you'll notice is when the federal funds rate reaches, can I turn off the tooltips? Is there a way to turn off the tooltips? Yeah, there is. Okay. When the federal funds rate in the last few eras, right, just in recent history, when the federal funds rate is at its peak, when the Fed's done tightening here in 2000, in 2006, and to a lesser degree in COVID, that was more of a shock. But in these two eras, you can see it here. They got done tightening, and then banks started tightening their standards, right? You see that right there? It didn't really begin until we were well into the plateau of federal funds rate. Well, over here, that's not the dynamic this time, guys. We have the banks tightening at the same time the Fed is tightening. Both these lines are going up at the same time. And so that is why I believe that we have seen such a rapid fall off in credit growth. And you can see business loans, consumer credit, bank credit, total loan creations, all of those are below the normal growth rates heading into a recession. The black line is today, the gray line is the average. All of them are well below, and in some cases 5 or 10% below average. Look at this. This is the average of the entire credit system, right? As the way I'm measuring it here. And it's at a 0.5% annualized growth rate, when normally at this point we're at about 11%. So we are 10% below normal credit growth. And I think a big reason for that is because of this dynamic over here, because banks are not creating loans. Oh, if NASDAQ takes the October low, where does BTC go? Well, let's go look at the NASDAQ. The NASDAQ is not the one that I've done the most study on in terms of its behavior in recessions and downturns. I mostly look at SPX. And if I go back far enough in time, I look at the Dow Jones. But the NASDAQ, we could look at the NASDAQ. I think what's important to note about risk assets is a lot of it hinges upon whether or not we do get a recession. If we're going to have a recession and we're going to see high job losses, then it's most likely that risk assets will break down, and it is highly likely that they will break below the lows of last year, because that's what usually happens. I've shown you guys this chart here many times before. This is a look at how much time goes by between the low in the recession and how long ago that price was last seen, right? How much history is erased by the fall in the recession. And what you'll notice is that the majority of these instances are more than 2 years, meaning the low in the recession takes out a low from the market that is at least 2 years old. In some cases, 3 years, 5 years, 6 years, or more. The Great Financial Crisis took out a 12-and-a-half-year-old low. Very rarely, though does occasionally happen, rarely does the low only take out price action from something maybe a year ago, a year and a half ago. The drawdowns are all over the place. The drawdown can be anywhere from about 25% to 55%. It's a huge range. But what's less distributive, what has a tighter cluster, is this right here, is the amount of time that is erased by the market. So when you look at it through this lens, what it suggests is it's likely that we're going to take out 2 years or 3 years of price action. Most likely, right? And so if that's the case, and we look at the S&P, and we measure out 2 years, where's my measuring tools? They've moved everything around here, and it's been hard to see it. Let's go back to September 21st. Here it is. Here we go. This is 2 years, right? And so if we're going to take out 2 years of price action, I mean, that means that we're definitely going to take out these lows. And maybe we even come down and we take out some lows from back here, right? And we touch something from 3 years ago. And then we end up, in our own way, printing a fractal somewhere in this range of the chart here, and we fit right within historical tendencies. What is Bitcoin going to do? It's probably going to set new lows itself, because in every recession, the market has set new lows. So these are the performance of the market after yield curve inversions. And let me actually cut off some of this here. Let me bring this down. Let's call it 900. Yeah. These black triangles are the low of the market. This vertical line here is when the recession began. And what do you notice about all of the triangles? All of them, with zero exceptions, are after the start of the recession, right? All of them. Those are the lows for that era. So that is an important trend to acknowledge. And if Bitcoin's never experienced a recession, and we do have one, then I think you have to be open-minded to the possibility that it sets new lows. And now, I don't know what that low looks like. I don't know if that is a low to 12,000 or if it's a low to much beyond that. But it's something that we have to be open-minded to. There's no reason why it cannot do that. It has nothing to do with constricted supply. It has nothing to do with the fucking halving. Nothing, right? It has to do with liquidity, with the cost of money, and with risk appetite broadly. And if we look at price as a range, and we had this range, let me put this on a monthly so it's even cleaner. Yeah. We had this range of the prior market. We have broken out of it. We're now trying to hold it as some kind of a support here. If this is lost through some kind of a drawdown in a recession, we start breaking down here. If we get below this level, then the way that I see it, I do not see it as, oh, well, we just like bounce off of some mystical 12K number and everything's fine. I think it's probably a lot more complicated of a situation than that, partly having to do with the pressures being placed on the Fed and what their response function could look like, but also we're only 3 years removed from COVID and massive stimulus. And so there's institutional resistance to doing that exact same thing again. So I don't know that we can expect the exact same outcome. There is a lot of ways that this is not March of 2020, as some of you have heard me say before. And so if we're going to get below this area, then I got to start thinking that maybe we find out what this range is all about. Maybe we start coming down here. Maybe we have to test this low again. I don't know, guys. But I do think that this low is not safe if we do have a recession, if we do see job losses. If that is what starts to manifest, then all bets are off. What's the worst case scenario? I mean, I could, doom wank for you guys, and say Bitcoin's going to go to $2,000 and not recover for 5 years or something. And then we're going to have some lost decade. But I don't know if I believe that. All I do believe is that we are highly likely to experience the first recession in Bitcoin's life, and that we have to assume that Bitcoin will perform in a way that is similar to what risk assets do in a recession, because that is how it behaves. And so that's what leads me to my beliefs. It's all data driven. It's not my opinions. It's not feelings. It's not that I want price to go there. I certainly don't want there to be 3K Bitcoin. But the thing that you should think about is, this is a point that XO made to me yesterday, and he's so right about this, is that the way to spin this is that, if you're going to have prices down here, or God forbid down here, those are buying opportunities. That's not scary. That's actually wonderful. If you have a long-term thesis, this is not advice for you, but if you're someone like me who believes that Bitcoin has a role to play going forward, then if I see a massive haircut on price, if we are anywhere down here, I'm backing up the fucking truck. I don't know what's going to happen, but I'm backing up the truck. Do I think BTC is recession-proof? Absolutely not. Nothing is recession-proof, guys. Nothing. Even gold goes down in recessions. Liquid assets go down in recessions. Everything does. It's just what recovers first, what leads the way out, what are the best things to allocate into during the recession. I don't have all those answers. We'll study some of that as time goes by. But there is no asset class that's just magically recession-proof. That's just kind of not the way it works. ETFs, I don't think really change anything. Here's the thing about the ETF. People assume that the ETF is immediately bullish for Bitcoin. It's bullish long term because it is a new way for people to access the asset that they could not access otherwise. But it doesn't mean that the price is going to go up just because we have an ETF, right? The price will go up. The ETF will see inflows commensurate with risk appetite at the time. So if we are in a recession, if we have, I'm just going to make up numbers. This is not a forecast, but if we have 5% unemployment, and if the S&P, if the S&P is down here at like 3,300 or something, again, I'm just making stuff up. Then I don't really think that they could launch an ETF and that it would mean anything. It wouldn't matter at all. And, a lot of people point to the gold ETF. They're like, well, look what happened to GLD when it launched back in the day, back in 2005. It was just absolutely ripping. And it ripped, all the way in through the great financial crisis. That's true. That's true. But before it did that, it had a 35% drawdown during the great financial crisis. And then it went higher. And also, it's also worth pointing out, which one is, we'll do U.S. oil. I could do the commodity thing, but we'll do U.S. oil. It's also worth pointing out that if you look at other assets like oil, like other commodities, they were in a bull market, right? This was a general commodity bull market in this period of time. There's a big crash in oil prices because of the recession. But gold was rising because commodities were rising. Similar thing with copper, I think. Let me throw copper on here too. New price scale. Yeah, same thing with copper. Look, rising as the gold ETF is rising. So if we're going to have a commodity bull market and Bitcoin ETF gets launched, well, maybe that's a good thing. But there isn't anything recession proof. Nothing. And gold is no exception to that. Gold definitely draws down in periods of toughness, right? When people need capital, when they need funds, they need money. They will sell liquid assets. Gold fell 34% in the Great Recession. Then it went higher. It did bottom before equities. And this is where I think it gets interesting, right? The bottom of gold was October of 2008. The bottom of equities was March of 2009 over here, right? It's about a 5-month difference. And so what I think you could perhaps anticipate for Bitcoin, similarly to how it behaved in the Great Financial Crisis, not the Great Financial Crisis, sorry. Similarly to the way it behaved in COVID, right? It started moving higher. Granted, S&P was also going higher, but I think that that's something we could look for. A drawdown, not a higher low. I think it will break below the lows over here. I don't think it'll be like COVID. But if we get a deluge of liquidity, if the Fed eases, if they start pumping the markets, then Bitcoin will respond, because that is what it responds to. It responds to liquidity and easy money. It doesn't respond to the halving. It doesn't respond to any of that stuff, to people figuring out that fiat money is a Ponzi. That's not what makes the price go up. What makes the price go up is risk appetite and demand. One more blow off top before the bottom falls out? Maybe. So what I've kept in mind for myself is that Bitcoin could go up into the retracement levels before it comes down. And that is what it did before. That's what it did in 2019. So if we just go back to this market here, a lot of people have been thinking that we're going to get one of these COVID drops right here. But what they have not acknowledged is that before we got the COVID drop, we got to move up into the retracements. Did we not? Here. We got to move up to the 618 Fibonacci off of the bear market. Then we created the low that came down and it tested this consolidation area from the bear market, bounced off of it perfectly, and then off she went. Right? That's what we got. And if we're going to do something like that today, we would probably need a move up into the retracements. And we've not even gotten that. I mean, look where we are. This is nowhere near the same thing as we had back over here, is it? You take off the extension. Yeah, like that. Look, 2019, we got all the way up into the retracements to the 618. Then we broke down to the COVID lows. We tested this structure and then we bounced out of here. Look where we are today. This is the 618. It's at 48,000. That we're so far away from looking like 2019. I just don't see this comparison here at all. But I do think there's room for a retracement rally. And it would need to happen with equities going higher. because that's usually the trigger. My buddy Blockchain Backer has talked about this a lot. Some of you guys also follow him, so this is not new information to you. But what usually sends Bitcoin higher is the Dow Jones going higher, right? You could probably also look at the S&P, but we'll just use the Dow Jones. Whenever it has broken out of its prior consolidation into new highs, Bitcoin then takes off shortly after that, within a couple of weeks or a month or two. And the Dow Jones is not that far from its all-time high. It is 8.5%. That's a couple of strong weeks away, 2-3 strong weeks away. And it could conceivably do this. This comes back to what we talked about near the beginning of the stream on my table here of rallies that have occurred after Fed tightening, right? So the Fed got done tightening, and in 1990, in the Great Financial Crisis, and in COVID, the market rallied 20-30%. But it happened over a year. It happened over 14, 15, 16 months. I don't know that we have that set up here today. But that doesn't mean that we can't just maybe pop up. Maybe just pop up and set a new high like that, maybe. If we did something like that, that's a danger zone look right there. That is something I have proposed to you guys before. Because we've seen this, haven't we? We've seen this exact behavior where an asset set a high, it had a bear market, it set a barely new high, and then it broke down. What asset did that? Y'all answer it before I even say it. BTC. Did this. Here. This was a full-on 50% drawdown, 55%, which is not a typical Bitcoin bear market, but it was a mid-cycle bear market. Then we set a barely new high, and we broke down. There are some other tech stocks that kind of look like this. Apple kind of looks like this. High, big breakdown, just set a new high, and now looks a little toppy. I don't know that it has topped, but it looks a little toppy, right? Same thing for Microsoft. Exactly the same. High, big drawdown, barely new high, and now maybe looking a little toppy. Can't say, looks a little bit that way. And so if we had BTC do this 2 years ago, and if you will recall, everyone thought this was the continuation of the bull market and that we were going to go to 100,000. We were just going to keep going. This was a retracement rally. This was a period of low activity. I mean, let's look at RSI. Look at RSI. We set lower highs on RSI, but we set a higher high on the price chart. That is a bearish divergence. So if we see something similar on the Dow Jones, that would be pretty alarming, and that would be a massive short setup if we were to see something like that. But what I've suggested is just to be open-minded, people, that we watched Bitcoin reach up in the middle of bearish on-chain and technical indicators, reach all the way up and print a new all-time high in a retrace, and then roll over in a bear market. And so do not rule out the possibility that the Dow Jones or even the NASDAQ could do something exactly like that. Don't rule it out. We won't let the markets crash until our buddies in Congress can sell the top. I like the way you think, Jerome. I like the way you think. Holy Schneike says, thoughts on interest rates and where they're going? Well, I mean, they've been drifting higher. And the thing that I think makes this difficult for people to read is they're looking at what rates and the yield curve usually do as we head into a recession, right? What normally happens, let me put my yield curve on here. I'm going to use the 2-year because the 3-month one doesn't go back quite as far on TradingView. But what normally happens is that as we get to the recession, the yield curve starts uninverting, right? Vertical bars are recessions. This is the yield curve. We make it a line, it's a little easier to see. And what usually happens, it starts to uninvert, to steepen. Where's the 0 line? Put this on 0. As we get to the recession. right? That's usually what happens. And people are seeing the yield curve here and they're seeing it move higher and they're like, oh, well, we're getting close to the recession. It's starting to move a little bit higher. But the tricky thing is, usually when the yield curve uninverts on the way into a recession, it's because the Fed is dropping front end interest rates faster than the back end, right? It's what's called a bull steepener in the yield curve. It means they're cutting short-term interest rates and those are falling faster than whatever's going on the long end with 10 and 30-year yields. And as a result, it steepens the yield curve by making the long end higher than the front end because the front end falls. That's a bullish steepener. A bear steepener is the same outcome, but created from the opposite effect, where the yield curve steepens, where 2-year yields end up being below 10-year yields. But the reason it happens is because the 2-year stays where it is and the 10-year goes higher. That is a bear steepener. That's the opposite of a bull steepener. That's the opposite of what we have normally seen in the modern era with the yield curve inverting. And that makes it really difficult to read because that's what we're getting today. That's the dynamic. I don't know if it's happening today. Maybe we won't see it on the chart here. Now we won't see it today. But it was happening yesterday and it was happening on Wednesday where you saw the front end, the 1 year, the 2 year kind of flat. And you saw the 10-year, the 20-year, the 30-year up big, up like 1%, 1.5%. That is a bear steepener. And if we get that kind of a thing where the front end does not fall, but the longer end yields go higher, that's going to put more competition between stocks and bonds. Because there's something called the earnings yield. Let me pull this up real quick. S&P 500 earnings yield. Let me see if I can find a chart of this before I bring it onto the screen. Yes, here we go. Okay. S&P 500 earnings yield. It is 4%. This is the inverse of the price to earnings ratio. This is it's based on EPS with the S&P. So the earnings yield is 4%. In most of our lifetimes, this has been a better bet than bonds, right? Because yields for the large part, at least in modern history, the last 20, 25 years, yields have been lower than 4% in most cases for a lot of the time. And in a lot of cases, the earnings yield in the S&P was higher. Sometimes it was 5 or 6%. So in those cases, it made a lot more sense to allocate to stocks than to bonds because they would earn more, right? They would outperform. But what we have now is an earnings yield of 4%, and the entirety of the curve is above 4%. Every single tenor of treasuries is above 4%. That means that if you're a big player in the market, if you're an asset allocator, if you're managing portfolios, you have to give strong consideration to doing what is called sitting in cash and just owning treasuries at a yield. I'm not telling you to do that because I'm not a big player in the market and neither are you. If you were, you wouldn't be listening to me. But that is going to put competition on the stock market for people to allocate to it rather than allocating their money to a 1-year yield or to a 3-month treasury that's currently at 5.5%. Why would you buy stocks at a 4% earnings yield when you could buy a 3-month treasury at 5.5% and have nothing to worry about? You could do that if you had no idea where the market was going, which a lot of people don't, right? We're in a really tricky spot. There's a lot of different factors weighing on the price. We have really no idea what it's going to look like 3 months from now. And so if you have high levels of uncertainty and you have a lot of money that wants to be allocated somewhere and you don't want it to just sit in the bank collecting dust, you're probably going to put it in treasuries, either through a money market fund or just through outright buying them yourself, and probably not allocating to stocks. And so if that's the case, and that dynamic has already been at play this year with yields being where they are and with the S&P earnings yield at 4. But if we get that dynamic I was describing where the front end, where like, let's say the 2-year doesn't go a whole lot higher because really it's kind of at the ceiling from the great financial crisis. But if the longer end yields do go higher because they are not yet at the highs of the great financial crisis, and they actually have some room to run. Well, that's going to exacerbate the competition between stocks and cash. And it's going to make it even less appealing to allocate to the stock market. So that's something to watch on the longer end of yields here if they begin to climb. It goes without saying that the US 10-year is probably the most important single instrument for markets. It is the benchmark rate for so much else that goes on, for so much financing that happens. The corporate sector, a lot of other countries' yields, they are benchmarked to the US 10-year in terms of their spread and their appeal. And so if the 10-year is going to climb up to 4.5% or 5% to levels we haven't seen in 20 years, then some shit is going to break and equities are going to struggle, most likely. Edu says, do you think recession is possible during an election year? Yes, absolutely. We have had recessions in multiple election years. One of the worst recessions of all time was during an election year. It was 2008. 2020 was an election year, and they shut down the global economy and almost sent us into a depression. The 2000 was an election year. The recession started super early in 2001, but the market was already capitulating, right? That happened during an inauguration. I think if you go back to 1982, 1980, that was an election year. That was in the middle of the Paul Volcker double dip recessions. So I think it's important to acknowledge that there is zero correlation between an election year and the possibility of a recession happening. There are ample examples of them happening during, right before, and right after election years. People will try to find edge in there. But what I can only articulate is Washington doesn't control the stock market. They can influence the stock market. They can influence the economy, but they cannot prevent a recession from happening through magic. They can't just decide, we're just going to put it off till 2025. That's not something that they're able to do. They don't have that kind of control. What usually happens is they don't think we're near one. They kind of try to glide us into a slow slowdown of the economy, and they end up breaking stuff because we have a giant fiat Ponzi that is reliant upon credit creation eternally. And so anytime they interrupt those things, they create a crisis. And, when you see how many people think that we could avoid a recession because of deficit spending, you can see how we can end up in a place where a bunch of people are wrong-footed by an economy that just simply can't keep going anymore. I don't know if that's going to happen, but we just have to be reasonable about these things, I get asked a lot, like, why don't I sound worried when I talk about all this recession stuff? I talk about a lot of bearish things, but I don't sound like scared. And it's because I've read enough history to know that it could be a lot worse. This is just like a May shower, right? It doesn't have to get worse. A recession doesn't have to be a depression, right? We just haven't had one in a long time, and Bitcoin hasn't experienced one. So we've got to be open-minded that we might go into a period of time that will provide new data for all of us. And that's exciting to me because I'm an analyst, right? I am hungry for data. And so if we're going to go into an era that we've never seen before, and an asset that I am partial to in Bitcoin is going to be there and it's never been there before, then I'm really eager to see what it does. I want that information. I want to collect some data. I want to see what happens. I'm not rooting for it, but if we're going to have it, then I'm going to spin it as a positive thing. It's experience. It's a once in a lifetime kind of thing to go through. And I'm going to be here for it. We're going to analyze it. We'll model the recovery out of the recession, just like we have modeled the downturn into one. So for me, this is all just analysis. I remove the emotion from it because it's very easy to get emotional, and there's plenty of other people doing that for you. If you want someone to get really fired up about this stuff, you can find an influencer to do that for you. That's not my style. That's not my behavior. That's not my personality. So be aware. Have your spidey senses enabled. Be paying attention. Do not be overexposed to a single direction in the market. Don't be super long on everything. Have some savings. Consider maybe having a portion of your liquid savings sitting in something getting 5%, because you don't know where things are going to go, and that is okay. You can always move it back out and reallocate. You don't have to catch the pico bottom of the market. It's far more intelligent, and it enhances your survivability to not get overly committed to a particular direction and to think about capital preservation over capital allocation. So if we're in a period where the S&P earnings yield is below the entirety of the Treasury yield curve, if we're in a period where labor is slowing down, commensurate with prior recessions, and we have a Fed forecasting an unemployment rate that only happens in recessions, then it warrants an abundance of caution. I think that's a rational mind frame to have here. You can still be long the market, but have an invalidation. If it goes below this price, I'm going to move X% into cash or into something else. Make that decision for yourself. Don't wait for something to happen and then try to figure it out in the moment. That is not what you want to do. You want to have thought about these things beforehand, because when stuff is happening, when the market is moving, every emotion will be tickled, every sensation will be brought alive, and it will be hard to think clearly. So go through that thought process now. I saw you tweet to Wifey Alpha about a short bonds call. Any view on holding bonds instead of cash funds? Now, I don't know, Metal Ants. I might be speaking out of my depth a little bit on that. I just think it's rational that if you have a lot of savings, if you have a lot of cash, if you have a large liquid position, that you be earning a yield on that in some amount of the quote unquote risk-free market, right? Through some element, either through money market funds or going on Treasury Direct and buying it yourself, or finding a bank that gives you a beneficial deposit rate. There are banks now offering 4.5%, 5% on a savings account. Everyone should have that now. Just in some portion of your portfolio, somewhere, you should have a bank account that's giving you over 4%, or you should have some allocation to a cash instrument that is giving you some kind of yield on your idle money. Because this is the first time in a couple decades when you could do that. You should be doing that, in my opinion, to some degree. Can a recession turn into a depression? Yes, through a period of prolonged below-trend growth. If the economy does not recover quickly enough that we start seeing a demand for workers and a fall in unemployment and a rise in the real rate of growth in the economy, then it can proliferate into what is considered a depression. Depressions begin as recessions. So that's kind of what I'm looking at here. Been asked to do these streams weekly, and I'm open to that. But what I would need to do, me personally, what I would need to do is figure out a way to limit the amount of content that I dump on you guys in a single stream. Because I am sensitive to the fact that I am conveying information to people who want to get it, and that I might be giving too much information in a single video. I've always kind of had that problem. And that's part of the reason I shifted to doing live streams, because it's easier for me to be off the cuff rather than having to plan it all out. But all these live streams have been an hour and a half, 2 hours. And that's a lot of information. And I'd really like to get them down to 30 to 60 minutes. So what I need to figure out for myself, and maybe it comes from doing them more often. Maybe that just naturally means we look at less data each time. But I want to get to a place where maybe we do one every Thursday or something, and we just kind of have a consistent weekly live stream. That's something I'm working on. I have to figure that out for myself. I'm just a one-man show, and I'm trying to get to that place. I'm the Joe Rogan of macro. Thank you. Thank you. I appreciate it. I'm just one man. All right. I don't have an economics degree. I did not go to college. I barely graduated from high school. I was a bartender for like 10 fucking years. And I am just trying to learn and get a sense of where we are in our place in history and our place in this market cycle, what that means for Bitcoin, which I'm very interested in as an outside money. And as a result of that, we come up with all this content to talk about. I come up with all these charts, all these data points to discuss with you guys. This is just kind of sprung from nowhere. I can't tell you guys in the chat right now, a couple hundred of you watching, I can't tell you how much I have been delighted and pleased and grateful that there are enough of you that actually want to hear from me, that we continue to make these videos and y'all keep showing up for them. So that's just awesome. It helps to fuel me. And I'm still learning how to be a content creator. So, probably going to start wrapping up here. Make sure that you hit the like button if you haven't already. We've got, how many likes do we have? 275. That's more than we have viewers. It's amazing. Thank you so much. If you haven't subscribed to my channel, you definitely should do that. If you have any opinions about, I asked you guys this before a couple weeks ago and got a lot of feedback, but if you didn't give me feedback then and you have an opinion on weekly or bi-weekly streams, feel free to leave that in the comments to the video or DM me or whatever you guys want. One thing that I have thought about, and I don't want to just start doing it out of nowhere if there's not an appetite for it, because I don't know, I read a lot of cool stuff, like cool financial history, and I find a lot of parallels between things that happened in the 1800s, in the 1700s, in the 1400s, going back into ancient China, and things that have a lot of parallels to lessons that should be learned today. And I've done this a little bit in spaces where I'll read something and then we'll have like a macro chat afterwards. But if there's an appetite on these video streams for me to maybe read a page or two out of a book, talk about how some of that relates to today, things that we've learned about paper money, some of the different societies in the past and their experiments with paper money and how they have blown up in spectacular fashion. I love learning about those things. If you are also interested in learning about those things in this format, not in me reading it in a space, let me know, But primarily this content will stay market focused and macro focused because that makes the best sense for a visual stream. So it's Friday. It's 12:40 p.m. where I live. Our stream's been going a little over an hour and a half. And I'm going to let you guys go. I've been caught up on the chat here. I appreciate the super chat from you, Big Shroom. Thank you so much. I am going to try to figure out how to get memberships on here. A couple of you guys have asked for me to let you be like a member of the chat. Your name will be a different color. Maybe we can get some emojis and stuff in here. I don't have any of that stuff yet, but I would like to get to that place, similar to what people do on Twitch. And also another idea. I have a lot of ideas. I talked to EXO quite a bit yesterday after I did his stream. And he suggested, he's like, man, TX, you should have guests on. You should have people on every once in a while and you should, ask them questions. And maybe I will start doing that. I've never done that before. I don't quite know what that would look like, but maybe we'll do that as well. BCB could be a good first guest. He's a good friend of mine. We've gotten to know each other quite well. So he'd probably be on the short list of one of the first guests I would have. But yeah. So we're going to start wrapping this up. Do episodes on macro history and the correlation today. It'd be fun to hear your opinion. Yeah, okay. I'll think about that. There's a lot of lessons to be learned about the past. What is important for me, what's been a major takeaway, is a lot of people believe that our troubles began with the founding of the Federal Reserve, or that our troubles began with John Maynard Keynes, Keynesianism, or that our problems began in 1971 when Richard Nixon closed the gold window and ended convertibility of the dollar to gold. A lot of people think those were the moments when everything went awry. But the truth is that the US has been experimenting with paper money for almost 300 years, 250 years. Since the colonies, since the pre-revolutionary colonies, we've been experiencing booms and busts through paper money experiments gone wrong. We had multiple experiments in the 1800s, a lot of bank failures, a lot of destroyed wealth, and none of that began in the 20th century. In fact, these experiments go back to ancient China, to some of the earliest known recorded history of paper money. And we have been going through these loops over and over again. And the funny thing is that a society will seemingly learn some of these lessons. And then about 80, 100 years later, a whole new group of people is on the earth and they don't know any of that stuff. And they go through the same fucking cycle over again. And what's kind of funny is that 80 to 100 years is the saeculum. If you read the fourth turning, that's the average span of a human life. And in the framework of Neil Howe, that is the rough length of a generational cycle in a society. And so there's a lot of patterns that overlap with each other. You know, you can look at Ray Dalio's long-term debt cycle. You can read Neil Howe's book, The Fourth Turning. Then you could go read a book about the history of American currency from 1700 to 1900. And you can find a lot of really interesting parallels. So there is nothing new under the sun. We have done all of this before. We have believed that we discovered better money before. We have been deluded by our political leaders into political expediency and the mistakes brought from that. There's a lot of lessons to be learned. And I think that our generation will experience one of these. I think we will experience our own financial crisis at some point. I don't know if it's the 2024 recession or if it's something further down the line. Could be. But our generation will be due for one. And I'll be here for it. Hey, BCB, I see you in the chat, bro. What's up? We're just about to wrap up here. So thanks, everyone, for tuning in today. We will tentatively schedule another one of these 2 weeks from now, as we have been doing. But I'm going to I'll talk to BCB a little bit, talk to a couple of my other friends and see maybe if there's a way to do them more often by cutting down the length of these streams. I don't want to keep you guys for 2 hours every week. That's just not realistic. So anyways, until we meet again, take care of yourselves, friends. Take care of each other. There's a lot of emotions in the market, especially when price is moving, right? You saw all of that coming out last week when the DXY got to range highs, when Bitcoin got to its range lows, when the S&P got to its local range lows. What happened? But in perfect sync, everyone got really scared and got really bearish. Suddenly, DXY is going to go to 120. The S&P is about to crater to the COVID lows. The recession is starting now. It's doomtown, right? Show me the price chart and we'll tell you what people are thinking. And that's exactly what's happened here. But those of you who have been following the channel for a while know we expected the DXY to come up here. We expected it to come up here when it was down here because it looked like a wick-off spring. And that's exactly what it has played out as. And we did that simply by looking at the chart and turning off all the news. So the news is important. Being informed is important. But the media is not going to provide you edge. And all they're going to do is react emotionally to the things that are going on in the markets. So tune that stuff down. Find high signal sources of information. And let's just try to go through this process from a rational frame of mind. Let's not get too ahead of ourselves. Let's not assume, oh God, this recession has to be a depression. Let's not assume, oh God, BTC has to go to 3K. Let's not assume the bottom is in and 4-year cycles are going to hold up because sound money. None of those necessarily have to be true. But we're entering a period that has a pretty unambiguous outcome historically. And that outcome tends to be unfavorable for risk assets. So that frames my thinking going in the next 6 months or so. And we'll just take the data as it comes, homies. So with that, I'm going to close up shop. I appreciate you. I love you guys. I'm going to go outside and touch some grass. And we will chat again here in the very near future. We may even run a spaces here sometime in the next few days. So until then, thank you, friends. Cheers to you. And we'll talk again soon, all right? Later, everybody.